Most all of us have a need for parking some cash, where the money is safe, easily available, and it can earn the most while sitting on the sidelines waiting for us to put it into action.
Put me in, coach. I'm ready to play.
The point of parking cash isn't to make you rich. If that's what you're thinking, then this is not the video for you. Parking cash has a very specific purpose in the short term, and that could range anywhere from your emergency fund, saving for a down payment on a house, holding cash for a market correction to buy back into the stock market, which is something I've been doing lately, or to simply renovate your existing house. Because let's face it, all of us with 3% mortgage rates aren't planning to move anytime soon.
Ain't nobody got time for that.
Because I don't think there's anybody out there that wants to go from a 3% mortgage to a 7% mortgage unless they absolutely have to, which is why renovating is probably the best option for most of us over the next couple of years. Let's get started with something that we all need, and that would be an emergency fund. It's more important now than ever with all of these layoffs that are happening both in the private sector, but also with all of the government jobs. I think we all get it. No job is safe, and the average length for those that are unemployed happens to be 22 weeks, which is precisely why every financial institution suggests that a person has an emergency fund of at least 3 to 6 months worth of expenses saved up. And these happen to be the expenses that you absolutely must keep paying on, like your mortgage, car payments, utilities, and of course your groceries. But here's our reality. 1 in 4 Americans don't have enough money in savings for an emergency over $1,000. And with unemployment rates increasing and companies and the government are downsizing, it's extremely important to have your emergency fund in order. Here's a quick breakdown of how much you should have in your emergency fund based on a few ranges of monthly expenses. This is just a rough indication to give you at least a ballpark of what you may need. But clearly, you should be mapping this out for your specific needs. So, for an emergency fund, do you think you should keep all of that money in the stock market?
That's crazy.
Absolutely not. No, that is not recommended, because stocks are going to fluctuate a great deal at the monthly level, weekly, and definitely on the daily level. The stock market doesn't give you any security or the ability to take your funds out immediately. A person would need to sell their stocks, then move the funds from their brokerage account to their bank account, which can take several days, if not a full week. So no, the stock market is not recommended for your emergency fund. A person's best option for an emergency fund is in a high-yield savings account because you can withdraw the money instantly, and it's FDIC insured up to $250,000. And I am not talking about those cheapskate conglomerates like Wells Fargo or Bank of America, because they are only offering rates of around 0.01%. In that case, you're losing the value of your money to inflation. You need to be in a savings account that offers at least 3% to be working in your favor to overcome inflation. And on the screen is a listing of banks that I was able to quickly find with the best rates available. And no, none of these banks or any institution that I reference in this video is a sponsor. I simply did a quick search to find the top rates. And if you know of a bank with better rates, then please drop it in the comments for others to see. For context, if you have $30,000 in your emergency fund, would you rather be earning $30, keeping it in a big bank like Wells Fargo, or would you rather be making $1,200 from a bank that's offering 4%? I'd like to think that's a no-brainer. I say this jokingly because I still can't convince my dad to move out of Wells Fargo. And if you have parked cash waiting to invest, then during an unpredictable stock market, gold stands as a solid safeguard in preserving wealth. But while gold prices have surged 10% year to date, mining stocks have lagged behind and are down negative 50%, creating opportunities for investors looking at the sector. That brings us to today's sponsor, Rua Gold, with a ticker symbol NZAUF, a gold exploration company focused on New Zealand's South Island. And here's what stands out to investors. Prime location. New Zealand is streamlining its mining approvals and cutting back on slow regulations, making it easier for companies like Rua Gold to operate. High-grade gold fields. The company controls 90% of the historic Reefton goldfield, where past mines produce gold grades 15 to 40 times higher than the global average. Strong leadership, led by CEO Robert Eckford, who co-founded Aris Mining and took a major pay cut to focus on Rua Gold because he sees the value in its future equity. And insider confidence, backed by big names in the gold and mining industry like Eric Sprott and Oliver Lennox King, with leadership heavily invested in the company's success. As always, do your own research. If you're watching gold, then Rua Gold is worth looking at, where I have more information down in the description. Now, the next items that I'll cover are cash accounts, money market funds, CDs, and treasuries. And at the end of the video, of course, I'm going to create a table to list out all the rates for all of these different areas to park your cash. And I'll start off with cash management accounts, which are similar to high yield savings accounts, but they are often offered by brokerages that allow you to seamlessly move the funds from your account and then reinvest it into the stock market. And in my opinion, if you are an investor of any type, then you should definitely have one of these accounts. Using myself as an example, I have a self-directed 401k where I had been taking a page out of Warren Buffett's book by selling some of my overvalued stock to take a little bit of margin. I had accrued almost 20% cash holdings waiting for a market correction. And of course, I don't want my cash just sitting there making no interest. That's where cash management funds come into play. These brokerages offer these accounts where they sweep the money to a supporting bank and they give out high interest. On the screen are a listing of cash management accounts and the rates that are being offered during the filming of this video. And as I mentioned, this is something I highly recommend all investors consider having when they choose a brokerage site, so their cash is still earning value when it's sitting on the sidelines. But if you're an investor, there's another option for part cash, and that's money market funds, which is a type of a mutual fund, but it's only offered by a specific brokerage site. A key difference on these from a cash account is that the money market funds are not FDIC insured, and they invest in securities like treasury bills and even municipal bonds, which may have some tax advantages. The downside is that several of them have a minimum investment amount, which you can see on the chart here on the screen. And as you can see, several of these have rates above 5%, and they have the liquidity of what you would expect from any mutual fund, where you're able to sell the security and then reinvest the cash as you like. Now, after all of those options are exhausted, the only two areas that are left are treasuries like T-bills and CDs, or certificate of deposit. And as a quick comparison, T-bills are sort of like loans that you're giving to the government, and CDs are sort of like loans that you're giving to a bank or a credit union. And if you want to boil it down further, CDs are great if you want the added coverage of FDIC insurance, while treasuries do not have any insurance whatsoever. They just have the backing of the US government. In addition, treasuries are not taxed at the state level, which could be worth a little bit more to you depending on where you live. Both of these options have similar rates around 4%, but the money is tied up for a fixed amount of time. So you don't exactly want to invest in these unless you know for certain that you won't touch them for that time period, because if you do, they may have fees associated with it. So here's the thing. With high yield bank accounts, money market funds, and brokerage cash accounts all being at or above 4%, I see much less value from treasuries and CDs over the short term because your funds are locked up. Granted, banks and brokerage cash accounts, they can drop their rates at any given moment. And that's the trade-off we all have to work with. Do you sacrifice the time in the investment for a guaranteed rate with CDs? Or do you choose more flexibility, not knowing how long the rate's going to hold? In either case, here's all of the charts on the screen once again for your review to see them all together. These happen to be some of the best options for parking your cash, and that happens to be for whatever your reason may be. And please, if you know of a better rate that isn't listed here on the screen, please drop it in the comments to share with everyone else. As always, thanks again for watching.